Seshadri, afternoon. Thanks so much for your time. First of all, I'd like to understand your view on the commentary which came in, commentary on growth, commentary on internals of inflation, because the market has never been so obsessed on macros the way we have in the last 6-8 months. How did you observe it?
Thanks, Ajay, thank you for inviting me to the show. Yes, indeed, the commentary I think was very positive. I think broadly what the RBI is telling us is that the excess accommodation that was provided during, and I'm sort of jumping straight to the conclusion here, that the excess accommodation that was provided during COVID times will be withdrawn. Once that is done, the RBI will probably take a pause. So if you look at a long-term chart of where interest rates is, if you look at a 10-15-year chart of policy rates, we are going nowhere into the upper quartile of that range. We'll be somewhere stuck in the middle if what the RBI expects pans out. And that is what I think is giving a lot of support to the market. The market thinks that interest rates will stabilize at a long-term median level, which is not really damaging to growth, etc. There will be a downward adjustment to value to PE multiples, which has in fact largely played out, and therefore the worst news is in the price. Of course, this is a developing situation, as you just pointed out. Oil prices is something that is difficult to predict at this point. Global geopolitical factors are difficult to predict at this point. But you could also argue that the worst has happened on that front, and now there is a little greater visibility. So, short summary: the news isn't as bad as one thought, but one will have to keep a hawk eye on, because we have been negatively surprised in the last. The market has been negatively surprised over the last 9 to 12 months. So the macros is something one shouldn't take an eye off at this stage. But there's a lot of positives coming out of the RBI commentary.
Seshadri, I'd like your opinion on growth on GDP front, which is the country's growth on corporate earnings front, which market valuations are based on. Do you think that the scale back of growth, yesterday IMF2, the latest agency to scale back growth, and even the earnings growth adjustments have been done for now, do you think? Has all of that been priced in by the market? Or do you think there is possibility and scope for further compression in valuation of the market, purely scaling back on growth?
Well, I think growth should be strong, through the year. I know that there are some downgrades coming through, but starting from the simple fact that this will probably be the first disruption-free financial year. FY23 will be probably the first disruption-free year in terms of lockdown. That itself gives an impetus to growth. I believe by the second half, the bottom of pyramid earnings should start to bounce back, and that would be a fillip to broad consumption. And I also think that the capex cycle will pick up both, in terms of the government spending and in terms of private capex, again, probably towards the second half of the financial year. But there's visibility on all these three levers for growth. So I'm quite constructive about India's GDP growth, and not just FY23. I think we are in for a longish spell of 7% plus growth, which we haven't seen for quite some time, in the latter half of the previous decade. So GDP growth, I think, would be constructive. There may be tweaks upwards and downwards, but the primary drivers remain. And I go back to the first comment I make. If interest rates stabilize at median levels compared to history, that will, my apologies, that will not be a disruption to growth. So I'm not too worried about overall growth coming down. The second point that you ask on earnings growth, if you look at consensus estimates, we are in for 3 years of double-digit earnings growth for the Nifty. Through from FY22, 23, and 24. I think there is very little risk. We recently did a sectoral, analysis of where the Nifty consensus growth is. And apart from a couple of sectors, which constitute about maybe 15-20% of the overall Nifty earnings growth, there doesn't seem to be a great deal of downside risk to any of the broader sectors in terms of how growth will pan out. So my sense is that you will see both strongest GDP growth and you will see broad Nifty earnings growth through the next 2 years, FY23 and 24. And that is why you will find a lot of support for market at slightly lower levels. We've already seen that at certain levels of the market, it tends to bounce back despite all the negative macro news, especially on the global front that we are seeing.
Okay, let's talk about how you are looking at your portfolio or the construction strategy which you are adopting. Manufacturing is a theme which you like, and it kind of makes sense the way we are doing well. Early signs of capex cycle, even SBI's chairman spoke about it on the channel with me today, along with RBI governor. Which area of manufacturing or many themes also, multiple themes, which you are trying to fit into your portfolio?
See, we are looking at manufacturing across, manufacturing is a broad word. But for capital goods is one area. It's a sector that was out of favor for a really long time. There is a survivorship bias among companies which are still there because a lot of the weaker companies have fallen by the wayside. So whoever is there is in a very good position to capture the growth which we think will be strong over the next 2 years. We are seeing some auto ancillaries which should start to look interesting at some point. Automobiles, which technically is also manufacturing, is another area where after 3 or 4 really bad years, once the chip shortage starts to ease, and there's some signs of that easing, there is no despite all the headwinds, demand on the ground across the automobile space remains fairly strong. So that as you said, manufacturing is a broad word. But these are some of the sectors: capital goods, automobiles, auto ancillaries, where we think that the next couple of years should be fairly strong.
Right. What about IT? IT also saw compression of earnings because growth was being scaled back, and the mother market Nasdaq was being decompressed in terms of valuation, down 25-30%. Do you think that growth worries are overstated in IT? And what about wage inflation impacting their margins?
So you asked, I think, 3 separate questions. So let me start with multiples. Yes, I think multiples were stretched, and with rising interest rates, there is a natural compression of multiples. That, I think, has largely played out. And that was only to be expected when the global monetary policy cycle turned adverse at the beginning of this calendar year. The second is earnings growth. We flagged that for the moment FY24 earnings growth could be vulnerable if the US goes into a recession. There is enough data to show that through the past, the IT earnings is a little cyclical with US growth. But that will be temporary because the larger opportunity remains very big, and we're looking at some data to show that these slowdowns usually last for a very short period and tend to bounce back. So as far as IT is concerned, there may be a little bit of vulnerability to FY24 growth, but beyond that, the longer term story remains intact. The valuations, I think, have the froth in the valuations has now come off, and most of the stocks are available at reasonable valuations. And you're talking about the margin pressures from wage inflation. I think this year is when the IT companies go back to the campuses to recruit. They were caught a little, off guard when the first initial demand surge came, and a lot of them had to go subcontracting or pass on really, huge wage hikes to lateral recruits. Now that their machine of recruiting from campuses is back, I don't think wage inflation, it will be there for sure. There's wage inflation across, all sectors in India, but it will not be to the extent that there was, in FY22. So if you take an overall look, growth will be strong, except maybe a little bit of vulnerability to FY24. Margins should be stable because most of the wage inflation pressures are over. And all you're left with is valuations. Valuations, I think, have corrected. So overall, I think the sector does look attractive from here on.
Right. All right, Chadri, we'll let you go on that one. Thanks so much for your inputs on market and the investing environment. Before we